Welcome back, Iguana investors, to the Investing Iguana channel, where we dig deep, break down financial results, and help you make better investing decisions right here in Singapore. Today's episode is absolutely critical if you own, are thinking about, or even just curious about Capitaland Integrated Commercial Trust, better known as CICT. Iggy here, recently ranked 8th in the 2024 Influential Tigers list by Tiger Brokers, and I'm excited to announce we've just crossed over 1 million total reads and 58,000 likes across our platforms. With more than 1,000 videos and 600,000 watch hours under my belt as of August 2025, you know I'll always give it to you straight, simple, and actionable. Let's get right into it. CICT dropped their half-year 2025 results, and wow, the headline stats look fantastic. But here's the catch. Not everything is as rosy as it seems at first glance. This episode, I'll guide you through the most important slides from CICT's results, breaking them down, one by one, in simple language. By the end, you'll know exactly what these numbers really mean for your portfolio, your CPF investments, and your next move in the Singapore REIT space. Let's start with the headline performance story, which comes from the highlights slide. CICT says distributable income jumped 12.4% year on year to 411.9 million Singapore dollars. DPU, or distribution per unit, climbed 3.5% to 5.62 cents. Their average cost of debt came down to 3.4%, and aggregate leverage shrank to 37.9%. Sounds like a roaring success, right? But here's the clincher. Most of this boost is from the Ion Orchard acquisition, which they completed late last year. You get a full 6 months of income from Ion in these results, versus nothing in the same period last year. Strip that out, and like-for-like revenue grew just 1.4%. So yes, operationally they've done well, but the big jump is more of a one-off. Now let's dig into the portfolio performance breakdown. This is where we look at where CICT's money comes from. Retail is the foundation. Suburban malls make up almost 29%, and downtown retail about 27%. Office properties are a big chunk too. With most assets right here in Singapore, over 95% of their income is local. The important thing here is that CICT's defensive strength, what keeps income steady during tough times, comes from these necessity malls in well-populated areas. Diversification between office and retail helps, but if Singapore's economy stumbles, so does CICT. Moving on to the distribution story. Year after year, CICT has grown its DPU, now at 5.62 cents, up from around 5.2 back in 2021. Distributable income is the highest it has ever been. That's great for Singaporeans counting on their REIT distributions for CPF or SRS contributions. But important note, DPU growth is a bit slower than the income growth as the trust issued more units after big buys like Ion. The next payout date is September 18th. This is steady, predictable income, the kind that makes CICT popular with income-focused investors. Slide 4 covers balance sheet and capital management. Simply put, CICT has a rock-solid financial position. Total assets stand at $25.57 billion, liabilities at just under $10 billion, aggregate leverage at 37.9%, and an interest coverage ratio of 3.3 times, which is healthy. Importantly, 81% of their debt is fixed rate, shielding them from future spikes in interest rates. Most assets are unencumbered too, so they have flexibility if they want to unlock value. For everyday investors, your yield is safe here, even if the market gets bumpy. But, and this is key for the penny counters, 19% of their debt is still floating rate. So a 1% jump in rates means 17 million more in interest expense each year, which could shave a bit off your returns. Let's talk about occupancy and lease management. This is the engine room for all real estate trusts, and CICT's numbers are impressive. 98.6% of their retail spaces are filled, almost as good as it gets. Offices are at 94.6%. The weighted average lease expiry for the whole portfolio is 3.2 years. Importantly, leases are well staggered across years, so there's no major cliff edge where a ton of tenants could leave at the same time. That is defensive, low volatility income generation. Now, for retail portfolio operating performance, rent reversions are positive, up 7.7% year to date in June 2025. Downtown retail rent reversions are nearly 7%, while suburban malls are even better at almost 9%. Tenant retention is strong at over 81%. Shopper traffic looks impressive too, but much of the growth here is again because of Ion Orchard. The true test will be sustaining this when the novelty wears off. If you ignore Ion, sales actually dipped 0.2% year on year. The business is well protected, but outsized future growth will need more than just a great tenant mix. Flip to the office portfolio. Office rents in Singapore for CICT average about $10.81 per square foot, compared to market averages of $12.10. High occupancy and diversification help offset global uncertainties. Yes, they have some international exposure, Germany with the Galileo project, and some assets in Australia. Those international plays are risky, but could pay off. Office tenants in Singapore remain sticky, and most are blue-chip sectors like finance, IT, and energy. Upcoming lease renewals are below market rates, so there's room for positive rent reversions ahead. Slide 8 zooms in on asset enhancements and divestments. CICT isn't static. They're investing big. Galileo Frankfurt is almost done, with nearly full occupancy, aiming for a green building certification and new revenue from next year. Singapore projects like IMM, Lot 1, and Tampines Mall are all underway, each targeting at least a 7% return on investment. The Capita Spring divestment was well-timed, brought in cash, paid down debt, and improved flexibility. Bottom line, management knows how to unlock value from old assets and drive new growth without taking reckless risks. What about ESG and sustainability? This is a major point of pride for CICT and Singapore PLCs in general. Every property in their portfolio is green rated, almost half at the highest platinum level. That attracts tenants, helps with financing, think $5.5 billion in sustainability-linked loans and green bonds, and keeps big international investors interested. If you want a REIT that doesn't just talk green but actually walks the talk, CICT is right up there. The last slide is about market outlook and strategy. CICT wants to stay Singapore-centric, but keep enough international diversification for safety. Asset supply is tight for the next few years, which helps keep rents stable. Full positive impact from the new Ion acquisition only starts shining now. Upcoming completions from all those enhancements should add even more rental income into 2026 and beyond. But don't fall asleep at the wheel. Singapore's GDP growth is projected between 0 and 2% this year, and consumers might remain cautious. Quick break here. If you want even more data, like full financial models, peer comparisons, or to see my DPU and NAV calculators, you'll want to check out the Investing Iguana Substack. There's always a link in the video description. Here's my overall assessment. CICT's report is solid. On the surface, it glows. But dig deeper, and you'll find growth is mostly from the one-off Ion acquisition. Income is steady, but big jumps will need more than just one landmark asset. Its strongest suit is defensive stability, great for CPF or SRS-linked portfolios, where safety and predictable income are the main goals. You are paying a premium for quality and reputation, with a unit price around $2.24, which translates to a price to book near 1.02. Let's make it crystal clear with my quick strategy table. Valuation, wait for a pullback. $2.10 to $2.15 is what I'd call value. Current yield is 5%, which is fair for a blue-chip Singapore REIT. Like-for-like growth is modest at 1.4%, so this is not your rocket stock. It is your fortress. The balance sheet is fortress-like too, at 38% leverage. Portfolio quality, elite. Nearly all retail units filled, and premium office assets in Singapore's best spots. Management execution of asset enhancements is proven, and their ESG credentials are among the best in the region. Economic sensitivity is mainly to Singapore though, so keep that in mind. So here's what Iggy would do. Hold CICT for safety, solid yield, and predictable income. Only buy if the price pulls back to offer more upside. Don't chase it just for FOMO. If you are looking for outperformance or fast growth, this isn't the REIT. If you want sleep well at night money for your CPF or long-term portfolio, CICT deserves a spot. All right, wrapping up. That's our deep dive into CICT's 1H2025 results. Rewind if you missed anything. I'd love to see your questions or opposing views, so drop them in the comments. Like, share, and subscribe if you found this helpful. For those who want to be truly ahead, premium members get early access to all our videos, usually a full week before anyone else. These are detailed walkthroughs, including urgent signals and early looks at major market shifts, all for just $1 a month. That's less than a cup of coffee, and it could save or make you thousands. Join the inner circle by clicking the membership link in the description. Don't forget to watch our recent video on top Singapore REIT picks for 2025. That'll help you see where CICT stands versus the rest. As always, keep your head steady, your money smart, and your investing resilient. This is Iggy, signing off.